listen to me, because what I am about to tell you could mean the difference between your children keeping the wealth you worked your entire life to build, or handing a massive chunk of it over to the Internal Revenue Service. You have spent 30, 40, maybe 50 years working hard, saving your money, and making sacrifices. You bought a home, you invested in the stock market, and you watched those assets grow. And right now, as you are sitting there either retired or right on the verge of retirement, you are thinking about your legacy. You want to pass these assets down to your kids, your grandkids, or your loved ones. But you are terrified. You are terrified that the moment you pass away, the government is going to swoop in and take 30, 40, or 50% of what you left behind in capital gains taxes. You have heard horror stories about families being forced to sell the family home just to pay the tax bill. I understand that fear. It keeps you up at night because nobody wants their life's work dissolved by taxes. But I need you to take a deep breath, because there is a beautiful, powerful rule written directly into the tax code that is designed to protect your heirs. It is called a step-up in basis. When you understand how this works, you realize that the tax system actually gives you a massive advantage if you play by the rules. But if you make one wrong move before you die, you could completely destroy this benefit and cost your family thousands, or even hundreds of thousands, of dollars. Let's break down exactly what basis means, because if you don't understand basis, you cannot understand how much money you are losing. Your cost basis is simply what you originally paid for an asset. Let's say 30 years ago, you bought a beautiful home for $100,000. That $100,000 is your cost basis. Now, let's say over the decades, the real estate market boomed, and today that house is worth $600,000. If you were to sell that house today while you are alive, the IRS looks at the difference between what you sold it for and your original cost basis. That difference is $500,000, and that is your capital gain. Now, yes, you have a primary residence exclusion, but let's look at this purely from a capital gains perspective. That $500,000 is a massive profit that is exposed to taxes. The same thing happens with your investments. You bought shares of a great stock or an index fund for $10,000 decades ago, and today it's worth $100,000. Your cost basis is $10,000. Your capital gain is $90,000. If you sell it today, you owe capital gains tax on that $90,000 profit. Here is the question that everyone asks me, Susie, if I hold on to these investments until the day I die, and my children inherit them, do they have to pay taxes on all that growth from the day I bought it? The answer is absolutely, unequivocally a no. Not if you handle it correctly. And this is where the magic of the step-up in basis comes into play. When you pass away and leave an appreciated asset to an heir, the IRS does something incredibly generous. They completely erase your old cost basis. They look at the value of the asset on the exact date of your death, and they step up the basis to that current fair market value. Let's go back to that house. You bought it for $100,000. On the day you pass away, it is worth $600,000. Your children inherit the home. Because of the step-up in basis rule, your old $100,000 basis is dead and buried with you. Your children's new cost basis becomes $600,000. Think about what this means. If your children decide to sell that house a month after you pass away for $600,000, the IRS calculates their capital gains by subtracting their new basis from the sale price. $600,000 minus $600,000 equals exactly zero. They walk away with $600,000 in cash, and they owe absolutely nothing in federal capital gains taxes. The $500,000 of profit that accumulated during your lifetime completely escapes capital gains taxation. That saves them tens of thousands of dollars in taxes. It works the exact same way with stocks, mutual funds, and investments held in taxable brokerage accounts. If you have $100,000 worth of stock that you only paid $10,000 for, and you leave it to your kids in your will or through a trust, their new basis is $100,000. They can sell it immediately, pay zero tax, and use that money to secure their own financial future. Second, if your fear is avoiding the long, expensive, messy process of probate court, do not try to solve it by adding your kids to your deeds or bank accounts. Instead, look into a revocable living trust. When you place your home and your taxable investments into a revocable living trust, you maintain total control over them while you are alive. You can sell them, move them, or do whatever you want. But when you pass away, the assets pass directly to your beneficiaries without going through probate court, and, most importantly, they still receive the full step-up in basis to the fair market value on the date of your death. It is the ultimate win-win. Third, remember that this rule applies to taxable assets like real estate, individual stocks, and traditional brokerage accounts. It does not apply to traditional IRAs or 401k plans. Those are pre-tax retirement accounts, and when your children inherit them, they will pay ordinary income tax on every dollar they withdraw, and they do not get a step-up in basis. So if you are deciding which assets to leave to your kids and which assets to spend down during your retirement, it is often far wiser to spend down your pre-tax retirement accounts and hold on to your highly appreciated stocks and real estate so your children can inherit them tax-free through the step-up in basis. You have worked too hard for too long to let poor planning ruin your legacy. Keep your appreciated assets in your name or in your living trust, let them pass to your children as an inheritance, and let the tax code save your family thousands of dollars. You owe it to yourself, and you owe it to the people you love.